Hello and welcome to the Ontario Mortgage and Real Estate Insights podcast. I am your host, Steve Hamoan. Today we're diving into some intriguing topics, starting with the question that's on everyone's mind. How far will fixed mortgage rates fall in Canada? Mortgage holders and hopeful homebuyers have seen some welcome news over the summer as both fixed and variable rates have been ticking lower. Canada's 5-year government bond yield, which strongly influences fixed mortgage rates, has been on a downward trend for most of the past few months. This is partly due to gathering storm clouds over the United States and Canadian economies. The Bank of Canada has introduced its first interest rate cuts in over 4 years, bringing its overnight rate, which leads variable mortgage rates, down by a total of 50 basis points in June and July. These developments have at least slightly improved the affordability outlook for Canada's housing market, although the question of how far rates might fall remains anyone's guess. Ryan Sims, a mortgage agent with TMG The Mortgage Group, has cautioned brokers against advising their clients that a significant further drop in rates is likely. Rates are coming down, which is good, but I do not know how much more room there really is to go lower, he told Canadian Mortgage Professional. I think too many people expect rates to go back to almost the COVID lows. They know they will not go right back there, but they expect them lower than where they currently are. And I just do not know how much lower we can truly go. The bond market, Sims pointed out, is already pricing in things that are likely to happen in 9 to 12 months, including a further weakening in the economy. That means interest rates already reflect a probable downturn. Equally, while the 5-year bond yield may continue trending lower, that will not necessarily see a corresponding drop in fixed rates, Sims recently emphasized. Borrowers should not expect an immediate basis point for basis point dip in their rates in line with bond yield declines. Eventually it will match, but it is going to be a bit of a lag. My prognostication would be for every basis point you lose in the bond market, you're probably only going to get about half a basis point, maybe 3/4 of a basis point to the mortgage rates themselves. Rafael Ambrozewicz, an advisor at Blue Shore Financial, highlighted that despite the stress test not applying to renewals with the same lender, it has helped many homeowners cope with today's elevated rates. So, what are borrowers being advised to keep top of mind? While the landscape may have changed somewhat thanks to recent rate drops, Sims said his advice for borrowers would remain the same. Understand what they are hoping to accomplish with their mortgage and select an option that allows them to achieve that. The choice between fixed and variable in the current market is still centered around that question, according to Sims. If you want financial security or you are comfortable paying that fixed rate, then pay the fixed rate, he said. If you are comfortable taking the risk of a variable, take the risk of a variable. In the long run, variable rates are expected to fall further, with the Bank of Canada seemingly set for another flurry of rate cuts in the coming months and moving into 2025. Lower variable rates down the line seem a safe bet. But the million-dollar question to me always is, will the banks start to loosen or tighten the spread on that variable? Sims said. Today, you can get it at prime -1. Maybe that goes down to prime -0.5. In that case, the variable rate went down, but unfortunately, the end result for the client was not as advantageous as it should be. Now, what is the outlook for the United States? South of the border, United States Federal Reserve Chair Jerome Powell appeared to open the door to a rate cut as early as September in comments during the central bank's annual retreat at Jackson Hole, Wyoming, last week. Still, Sims noted that the United States economy, while softening, is showing more robustness than Canada's, a fact that could dissuade the Fed from cutting rates several times before the end of the year. Some of the economic data in the United States is gloomy, but on the other hand, we saw retail sales that came in above expectations, he pointed out. Everybody got upset when the job numbers missed estimates, but the United States still created 110,000 jobs. So there is a little bit more strength in the United States than there is in Canada right now. I think the market is baking in more rate cuts than the Fed will give us this year. Rising consumer debt in Canada is placing significant pressure on households, with mortgages now making up nearly 3/4 of the total debt load. As Canadians await potential relief from high interest rates, many are feeling the squeeze, according to TransUnion Canada's latest Credit Industry Insights report. It revealed that Canada's total credit debt surged to $2.41 trillion in the first quarter of 2024, up 3.2% from the previous year. Mortgages, which account for 74% of this debt, have remained relatively stable due to strong credit quality among borrowers and rising home values. However, the burden of non-mortgage debt, covering credit cards, personal loans, and lines of credit, continued to grow, reflecting the financial strain many Canadians are under. New mortgage originations have also stalled due to elevated interest rates, leading to an increase in housing supply as some potential buyers remain on the sidelines. Matthew Fabian, Director of Financial Services Research and Consulting at TransUnion Canada, suggested that potential interest rate reductions by the Bank of Canada could provide some relief to consumers. However, lenders need to carefully monitor consumer behaviors and predict and identify resilient versus vulnerable borrowers, Fabian added. Our analysis shows that a 50 basis points decrease in mortgage interest rates from current levels could reduce mortgage payments by 12% or more for new or renewable mortgages openings in the coming months, and help reduce the number of Canadians that are unable to make their monthly payment. The TransUnion Credit Industry Indicator saw a slight decrease of 1 point from the previous year to 104.5, attributed to a slowdown in credit supply and rising delinquency rates. However, this was partially offset by higher balances and strong demand for credit. Credit access has expanded, with the number of credit-active consumers growing by 3.7% year over year. Currently, 32 million Canadians, or approximately 92% of credit-eligible adults, have at least one active credit product. Younger generations are driving much of this growth, with Millennials and Generation Z contributing $98 billion to the increase in outstanding balances year over year. Generation Z consumers in particular continue to enter the credit market at a rapid pace, often starting with credit cards as their first credit product. This influx has contributed to a 10.4% year-over-year increase in new credit openings, amounting to $77.9 billion in balances, with new credit card balances alone growing by 7.5%. The report noted that average balances for major credit products held by Canadians continued to rise during the second quarter of 2024. Auto loan balances saw the highest growth at 6.2% year over year, driven by higher vehicle prices. Credit card balances grew by 4.7%, while installment loan and mortgage balances increased by 4.4% and 3.1% respectively. Despite rising affordability challenges, the majority of young Canadians still view homeownership as a valuable investment, according to a recent Royal LePage survey. A full 84% of Canadians aged 18 to 34 said homeownership is a worthwhile investment, with even higher percentages in Saskatchewan and Manitoba at 94% and Atlantic Canada at 93%. Of those who do not currently own a home, 74% said purchasing a home is a priority for them. It is not surprising that young buyer hopefuls see immense benefits in homeownership, said Royal LePage Chief Executive Officer Phil Soper. However, with high home prices and elevated interest rates, many feel it is increasingly out of reach. Just 54% of those who prioritize homeownership said they believe it is an achievable goal, with another 26% saying they are unsure. The youngest cohort of homebuyers in Canada have no shortage of barriers on their path to ownership, Soper added. Though the cost of borrowing has begun to come down, chronic supply shortages have kept housing prices from dropping, even as demand softened under the weight of high interest rates. The survey highlights that 60% of young Canadians who do not currently own a home plan to purchase one within the next 5 years. However, financial barriers remain a significant hurdle, with nearly 2/3 citing down payments as the biggest obstacle to homeownership. Despite these challenges, many young Canadians are willing to make sacrifices, such as relocating to more affordable areas or reducing non-essential spending to achieve their goal of owning a home. Interestingly, the desire for homeownership among young Canadians is driven by a strong belief in the long-term financial benefits of owning property. Nearly 3/4 of respondents view homeownership as a solid investment, particularly as a means of building wealth over time. This perspective aligns with the broader Canadian belief that real estate is a secure and appreciating asset, even amid market fluctuations. However, the report also points out the growing frustration among young buyers, many of whom feel priced out of their desired markets. This has led to increased interest in alternative living arrangements, such as co-ownership or purchasing smaller properties. Some young Canadians are also delaying their home buying plans in hopes that market conditions will eventually improve. In today's episode, we are closing with a topic that is hitting close to home for many Ontarians. The affordability crisis is forcing a shocking number of people in Ontario to live with family members longer than in previous years. According to Equifax Canada's latest analysis, nearly one-third of households in the province now consist of multiple generations living under one roof. Equifax Canada's report highlights how economic pressures are transforming the face of Canadian households. In Ontario, 32.8% of people live in multi-generational homes, a figure that surpasses the national average of 29.2%. This trend has been driven by several unfortunate factors, including high unemployment rates, fewer job prospects, prohibitive rent and real estate prices, and an overall exorbitant cost of living. The financial struggles are not limited to just housing affordability. Ontario leads the nation in credit card, mortgage, and auto loan delinquency rates. This growing financial strain is prompting many young people to rely increasingly on the support of their parents and grandparents. The report also noted that the percentage of multi-generational households in Canada has jumped by 2.5% since 2014. This rise is even more pronounced in Ontario, where economic challenges have made it difficult for many to afford living independently. The high cost of living, coupled with stagnant wages and limited job opportunities, is pushing more families to combine resources and live together. This transformation in household composition is a direct response to the harrowing fiscal challenges of our time. While multi-generational living can offer financial relief and emotional support, it also comes with its own set of challenges. Privacy, space, and differing lifestyles can create tension among family members sharing a home. As we navigate these challenging times, it is crucial to consider the long-term implications of these living arrangements. Policymakers and community leaders need to address the root causes of housing and economic instability to provide more sustainable solutions for Ontarians. That wraps up today's episode of the Ontario Mortgage and Real Estate Insights podcast. I hope you found our discussion insightful and useful. Stay tuned for our next episode, where we will continue to explore the latest trends and developments in the real estate and mortgage markets. Thank you for listening, and take care.